Hello, today we're going to be looking at PepsiCo, ticker symbol PEP. Currently we are looking at their free cash flow. Their free cash flow, as you can see, declined 18.19% from 2021 to 2022. If you scroll on down here, there's some things that we can highlight here. So as you can see, we're going to go to 2013 since we're going to look at the last 10 years. We have it at 7 billion, and now we're down to 5,855. So as you can see in 2019, it was at 5,587. So 2020 and 2021 were during COVID years. So are we going to be going back to similar cash flows, or are we going to continue an uptrend like we saw in 2020 and 2021? So if we go from 2022 to 2019, we did the math right here. It's 4.58% increase. So that's just something to look at. That's not really good year over year, but we need to know about their free cash flows going forward. Now, as you can see here, if you look at 630 compared to 630 of last year, we have an increase. So that's something to highlight. It's not much. This is in millions, but it's still an increase. And as you can see here, if you look at this one to that one, see it was decreased there. So we're going to need to look at September going forward to kind of get an idea of what their cash flow is going to look like. And speaking of their cash flow, let's go to the assets and liabilities. We have total assets. They're currently on the increase, and it's at 95.906 billion over the last trailing 12 months. If you go to long-term debt, they do have an increase in debt, and it's at 36 billion. Total liabilities currently at 78 billion. That's an increase year over year. So they do have more assets than liabilities. They do have a lot of cash on hand, but they do have long-term debt. They should be able to pay it off, though. They're really good because their revenue's increasing, as you can see, 10% year over year at 90 billion. So if you do come over here and look at their EPS, it's at 5.72 over the last 12 months. And, that is a decrease, as you can see here, year over year. But they are expecting it to decrease. See, as the last quarter, it was up 93% at 1.99 compared to last year. See, 1.03. So 1.99 plus 1.40. We're just going to come over here, and we're going to go ahead and do this. So we go 1.99 plus 1.40, 3.39, because they are expecting it to increase. We're just going to want to check this out real quick and see what the final number is going to be. Times 2, 6.78. So they're probably going to increase that. So if we come over here to Benjamin Graham, we can see we put in the EPS of 5.72. 7% growth rate is what they're growing their EPS. 4% corporate bond rate. We're doing a PE of no growth 25 for Pepsi since they're currently trading at a 31 PE. I would probably drop it to 20 to give yourself a margin of safety, especially if we're going to be doing this based upon what they expect. So if we're going to come over here for the 6.78, so as you can see here with the 5.72 with 25 PE, we have an intrinsic value of $157.74. If we drop this to 20, it would be $126.28. So let's go ahead and enter in 6.78 based upon this year's most likely EPS. Well, based upon the current trend. And we would come to an intrinsic value of $149 if we wanted the 25 PE ratio. $186.97. Still getting better, guys, but I'm doing good. Let's come over here to their dividend discount model. Dividend discount model, current dividend per year 5.06. They've been growing it at about 6.78%. So we have 6.50% growth rate. Discount rate, we're using 10%. That gives us $153.97. Now, if you're one of those people that likes to use a 8.5% discount rate for a company that's good like PepsiCo, it's going to change our numbers drastically. So it's going to come to $269.45. Then your discount rate's right here. So then it would be currently undervalued based upon this. But I like to give myself a margin of safety. So 10%, $153.97. So it would currently be a little bit overvalued. As you can see here, we can put in Pep. Okay, well, it didn't pop up, but that's okay. We're going to come to our discounted cash flows. We entered it in. Our average free cash flow, 6,921. 6% growth rate, 8% discount rate for a company like Pepsi. 134, 1384 outstanding shares. So 1,384 outstanding shares. Dividend discount price of $115.71. 10% discount rate to our 40% discount rate. We're also going to come over here to our discounted cash flow calculator too. See, we entered in the average cash flow. We have a 6% growth rate, 2% perpetuity, 8% growth rate. Outstanding shares, 1384. We come to $147.24. There's our discount rates. And then also, if we subtract their cash on hand and their debt, you can see the value. We do it to this calculation, and it becomes $125.89, which is still more than our other discounted cash flow, because this discounted cash flow calculator is our aggressive calculator. And that's how we do it if we don't want to give ourselves as much margin of safety for a company like Pepsi. Then you would look at something like this. It would still be a little bit overvalued based upon their current cash flows. Now, if you want to come over here to the dividend discount model, you can see it's growing at 6.5%. But let's say you think that it's going to be coming down a little bit over the long term, because it's been growing at around 7% for the last 10 years. So if you wanted to give yourself a more margin of safety on the dividend discount model, just to come up with a number for yourself, an idea of if it was only going to grow at 5% going forward, then you can see it was at $106.26. But if you want to predict their next one, and we're going to go with 6%, and then you want to come over here, so you'll take their current dividend, 5.06, because they're getting ready to tell you when their increase is going to be, and grow that dividend again. So you want to get a head start on it, and you go ahead and go here. So it's going to grow by 30 cents. So if we came here and we just said this, so it grew by 30 cents. We're going to do a discount rate if you don't want to be aggressive, and it only grows at 5%. So it'd be $160.80, and that's very similar to our current growth rate with the current numbers. And the 8.5 growth rate. See I put that 6. See, it increased by $9. if you do the 30 cents, leave it at the 5% growth rate. There you go. So these are just ways that you can look at it, if you're trying to get ahead of the ball and calculate numbers before they happen and have an idea of what the future looks like. This is a great way to do it. Now, if you're one of those people that believes they can continue to do the 7%, so we would, which is right around this number. This is 6 and 3/4, so 75. So basically 7% growth rate. 675, 530, 8% discount rate. That's what you would get, but based upon the current numbers, this would be your price. Makes a huge difference. So yeah, that is my valuation for PepsiCo, and if I was going to be determining a final value based upon the numbers today, I would go back down to my 6% growth rate, give myself a 10% discount rate here. So we're going to have $134.09. So you want to put this in over here. So we'll do 134. Benjamin Graham, I'm going to take this down to 5.72. 157. And then depending upon the discounted cash flow, we're going to use this analysis, 1.5, $115, because I like to be less aggressive. If we use the aggressive one, it'd be 147. So let's go ahead and put 115. That would give us a value of $145.05, and then 10%, 50%, and 20% discount rate. So currently, I would say that PepsiCo is overvalued based upon these numbers, but I could understand how people would say PepsiCo is fairly valued at the moment, based upon these numbers, because there are going to be people that are going to calculate this with an 8% growth rate, 8% discount rate. So they're going to see Pepsi as significantly overvalued, and I would totally understand this. And I don't think that it's wrong, and I think that Pepsi can totally grow at this discount rate. But for me, I like to have a margin of safety, and I like to be conservative, so I'm not going to take this chance, and I'm going to go ahead and give myself that 10% margin of safety. So thank you, and I hope you guys have a good day.